Welcome to Bloomberg ETF IQ. I'm Katie Greifeld.
And I'm Matt Miller. We are looking at, on this Monday, we saw 10-year yields rise over 5%.
Indeed.
And Bitcoin up over $31,000.
Well, yields went back down. I haven't looked at Bitcoin.
All right, let's get to the biggest stories now in the more than $10 trillion global ETF industry. I don't know why I just did that. More volatility in the bond market as the U.S. 10-year yield hits 5% for the first time since 2007. But as Katie pointed out, they quickly pointed lower. Some people are blaming Bill Ackman because he covered his shorts and told us all about it.
Taking a cue from Bill Ackman, let's also talk about BlackRock because they're going back in time, launching a basket of ETFs intended for retirement investing.
And as I mentioned, Bitcoin hits $31,000 and goes straight through it. The price move comes as the crypto industry waits with bated breath for a spot Bitcoin ETF approval after we had a fake out when you were gone.
We did get a fake out 1 week ago today. I was on vacation. It was a great 20 minutes. Matt, as always, Eric Balchunas from Bloomberg Intelligence. He's here with us now. He's looking at the flows. Eric, what do you got?
Katie, Matt, thank you very much. The flows are not great. I got to be honest. It looks like it's good at the top, right? You got IVV and OEF. Interesting. That's the S&P 100, so the biggest 100 names. That's pretty good. And then SPY. Problem is the numbers aren't that big, and you add up to a negative 2.5 billion for the week. And then you see some treasuries in there. TLT, again, people cannot resist. EMXC is interesting. That's emerging markets ex-China. EM hasn't taken in a ton of money, but it's really taken in money in active and the ex-China trade. So people getting very specific in emerging markets if there is a bid. Let's look at the outflows, and you'll see why I am just calling this a little more bearish. Look at the Qs. That's a negative 3.6 billion, and then rarely you see VU and VTI in there. That's Vanguard with 3-4 billion there in outflows, IWM, small caps, HYG, USMV. A lot of retail outflows there. So I think it's a good time to look at our traders versus retail index that we make on BI, and we track flows into ETFs used by the buy and hold crowd like Vanguard and Schwab versus ETFs used by traders like SPY and whatnot. And so the white line is the traders ETFs, and you can see they've been bearish for a couple weeks. But look at this line here. This is the retail. So they still are eking out some inflows. But compared to what they normally do, it's definitely down. And this is, you want this to be up, because if this goes down, we're in trouble. This line is all over the place. Traders are very fickle. But the Vanguard bid, typically you can count on it. So this is interesting, right, Katie, Matt? The Vanguard bid dying down a little bit is the first time we've seen this in a couple years, to be honest. And with the trading crowd coming out, it just doesn't set up very well.
Yeah, and that dovetails with the active divestment story that we have on the Bloomberg terminal, which is pretty shocking, although that's more of a mutual fund story. In any case, Eric, thanks very much for that. Joining our conversation now is Anna Paglia, Global Head of ETFs and Index Strategies at Invesco. Anna, I don't know if you saw Bloomberg's story, but people are pulling money out in the hundreds of billions of dollars over the past couple of years from active mutual fund shops. What do you think about the ETF situation that Eric just walked us through in terms of buy and hold investors versus traders?
Sure, that's a really good question. You always have to look behind the story because you need to separate the content from investment vehicle. When it comes to the investment vehicle, I think that we all agree that the ETF wrapper is the modern way of going about it because it's cost effective, it's tax efficient, you can trade in and out, you don't have front load fees, transaction fees. So the vehicle is obviously a preference towards ETFs. The content is different because true alpha, real strong alpha, is going to be there. So what you see, is it the death of a mutual fund or is it the death of active capabilities? Active capabilities are not dying. They are transitioning, and we are seeing it today. They are transitioning to a vehicle that is much more efficient.
For the record, that was my internal take as well. I just want, you guys saw the IB this morning, me and Ruch.
So
and
that's on the record. It's on the record. And that's, of course, one of the big stories this year, that bid into active. One of the other big stories this year is the bid into bond ETFs, even though if you look at the price return, it's been pretty brutal. To bring that into your lineup, of course, Invesco has bullet shares funds, which basically invest along a specific maturity date. And you look at them, I believe you have something like 31 ETFs. They've taken in $3.5 billion year to date. Talk us through the demand for this type of specific product and who is exactly is buying this.
So, Katie, this is one of those stories where what is old is new again. Look at at the uncertainty that we are living through these days, Fed interest rate hikes, everybody's always watching the Fed, what the Fed is going to do next. Laddering is a really old technique. If you want to make interest rates invisible to you, what you do is ladder. And what we have seen is that over the last 2 years, very good flows into our bullet shares ladders really show that investors are either betting on how the interest rate conversation is going to go, or they are going through the entire ladder as to make it invisible for them. We have seen an uptick in the bullet shares flows. In the last 2 years, in the last 24 months, that suite has grown by $10 billion, and it is also becoming the go-to exposure for institutional investors like insurance companies, which is something new in the industry.
Actually, can I follow on that? Because I believe there's been some interesting law changes in terms of how insurers can actually treat fixed income ETFs. My understanding is they used to have to treat them in New York as equities, but now they can be treated as fixed income ETFs. I've been trying to nail down that story for a while, what impact that's having, and you're saying you've seen it in your lineup.
We are seeing it in the lineup, and this regulatory change is actually being the catalyst for some of these, for the acceleration of flows, because the treatment of ETFs as equity or fixed income is really having a big weight in the balance sheet of these investors.
Let's shift gears to the equity market. You have 2 ETFs and in your notes that are really interesting. The Qs, which we all love and know, has had an incredible 15-year run. And then you have the equal-weighted S&P, which is sort of like taking the Super 7 down many notches. What do you do going forward? Because the Qs just seems to always come back and destroy everything. no matter how many head fakes small caps has or international. But then here you go into equal weight and you don't get the Super 7 stocks.
Right?
I do.
Yeah.
I do. And I guess going forward, what are you hearing from clients? Are they looking to beef up the Super 7 or go the equal weighted route?
Well, you need to separate the Qs from the S&P 500 equal weight because to us, concentration risk, especially in the S&P 500, is real. If you want your portfolio to be exposed to 500 companies, having concentration there is really not good. If you think about the numbers, the top 10 holdings of the S&P 500 account for 30% of the index, which is a concentration we haven't seen since the 70s. So for us, the equal weight S&P 500
but they make the money, right?
They make the money, and it's great when they make the money, but when they don't make the money, then your entire portfolio is really not in line with your expectation. The Qs is different because it's more of a thematic exposure. What you want when you buy the Q is really the story of innovation, technology, healthcare growth, and concentration there is not as big as a concern as you would have with the S&P 500.
I'm just looking at the NASDAQ 100, and I mean, they're worth obviously a lot more. In that index, isn't that a better place to put an equal weight opportunity into an ETF wrapper?
You could do that, but if you do that...
Could you do that?
I could do that.
Why don't you do that?
I could do everything. I don't do that. It's intentional. I don't do that because the power of the NASDAQ 100 is in those mega caps. Actually, we created another fund, which is QQQJ, to take away the mega caps for those people, for those investors who want to have a bigger exposure to the mid-cap segment of the NASDAQ-listed companies. But for us, the purity of the Qs is undeniable. I mean, you look at the numbers, look at the performance. You know, people lie, but figures don't. So if you look at the numbers, I think you have the story about the NDX.
Yeah, the Qs are a monster in a good way. And we don't have much time with you, but maybe it's not an equal weight NASDAQ 100 fund, but what should we be looking for from Invesco? What's top of mind for you right now?
Well, what's top of mind is digital assets. So
same for us too,
and for everybody on their ankles out there, I guess. So we keep watching the developments that are happening in Washington when it comes to Bitcoin ETFs, but we look at the wider space of digital assets. So it's not only cryptocurrencies, but it's also blockchain technology, and how can you give equity exposure that tracks the performance of these segments. So what watch the space, innovation, growth is still top of mind for us.
We could spend an hour with you. Please come back, Anna. Anna Paglia there of Invesco. Coming up, speaking of, spot Bitcoin ETF speculation persists, and the rally of Bitcoin goes over $31,000 a piece. This is ETF IQ on Bloomberg.
Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with PFIX. Of course, this ETF coming from Simplify, and it's absolutely been crushing it amid this bond rout. It's up about 39% so far this year. It's up over 200% since the end of 2021. And the reason why is basically it employs swap options. And what you need to know is that's like buying a put contract on the 30-year Treasury yield. So as the yield goes up, so too does this ETF. Let's also talk about exchange-traded notes. Not something we talk about too often, but Credit Suisse making some interesting changes to its lineup. Of course, they used to be one of the biggest issuers of ETNs. They had 12 outstanding, but they announced last week that they're going to close 9 of those ETNs. They're not retreating from the space altogether, though. Those tickers that you see on that screen there, they are keeping 3 of their ETNs in business. Let's also talk about GBTC, because obviously a lot of speculation over when we're going to get spot Bitcoin ETF approval, and all the while you've seen this discount to its net asset value narrow and narrow. It's currently at about minus 11%, Matt. We were looking at close to minus 50 at the end of 2022. Yeah,
huge comeback there in terms of the discount to NAV. Katie, Bitcoin passing $31,000 in the last hour on separate but similar speculation. Let's talk with Bloomberg's Vildana Heinrich about this. So there's a couple of different stories, Vildana, at play in terms of digital assets. One is GBTC's legal tussle with the SEC about whether or not it can convert to an ETF, and then of course there's a million issuers who want to put out a spot Bitcoin.
A million is the correct number, yes.
Yeah, that's the right number. What do we think is going to happen first?
Well, we are waiting. I think part of the reason that we are seeing the rally in crypto assets is that people are waiting for a new mandate, more information around what's going to happen in terms of the GBTC conversion process. So we're waiting for courts to basically tell Grayscale, this is how the process might play out. That could happen first. Maybe some of the other issuers could get approval first. The thing that's uncertain this time around is that we've not really seen something like this happen before. You don't really see asset managers suing the SEC in this way, trying to convert a trust into an ETF, etc. Obviously, we don't have a Bitcoin ETF, so it's a little bit of a guessing game, and a lot of it could be this, it could be that.
It's very strange, right? Because you have these two things happening in parallel. Of course, Grayscale versus the SEC, and also this race among everyone else, which includes, of course, BlackRock, Invesco, et cetera. When we think about that race specifically, all the other issuers who aren't suing the SEC but still have spot Bitcoin ETF applications, what's the latest timetable that we know of?
So over the next couple of weeks, we're very likely to see updated filings from a lot of the issuers that tell us what ticker, for example, they'd like to list under, the fees, which is a sort of a big point of interest for the industry because this product has been so hyped up. But we do have some intermediate deadlines coming up over the next couple of weeks, like in November, for example. The big one that a lot of people are looking forward to is in January, which is when the ARC21 shares application has its final deadline. And so the thinking is that potentially, if there's going to be approval, it could all be happening around that time frame.
What are we going to see in terms of fees? I mean, because ETF fees are very low, right? And GBTC gets to charge what look like monstrous fees next to that.
Yeah, so GBTC makes more than $300 million a year just based on its management fee. That's according to calculation just based on its assets. That's why it's such an interesting point, because the average ETF, it will charge something like 0.54, and so compare that to 1% or 2%, it's much higher. So it is a point of interest in that a lot of these companies, a lot of these issuers will maybe make the argument that a Bitcoin ETF is just a much more complex, complicated product, and maybe that's why it might have a higher fee attached to it. But really, we'll hopefully be able to see in the next couple of weeks.
Yeah, we have a lot to keep us busy. Vildana, really appreciate your time. That is Bloomberg's Vildana Heinrich. Now, still ahead, we're going to drill down into one of BlackRock's newest ETF lineups with BlackRock's Global Head of Retirement Solutions. That's next. This is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Matt Miller alongside Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence, back with us now for today's drill down, where we focus on one ETF. Eric, hit it.
Katie, thank you. Today we're looking at an interesting ETF. We've never done one of these on the show. It's the iShares LifePath Target Date 2045 ETF, ticker ITDE. And this is an ETF that invests in a bunch of asset classes at once. You basically are looking at an ETF that's used for retirement, right? It's like a set it and forget it. And it's going to go from like 100% stocks, and then gradually as you get closer to retirement, it shifts more to bonds. And I picked 2045 because I hope to be retired around then, so this would be for like a Gen Xer like myself. So let's look at to see what it actually holds now if for somebody who wants to retire in about 20 years. And you can see here it's mostly equity still, so pretty aggressive, some bonds, but again, this will increase as we get closer to my target retirement date. And then it is 64% US, so a good chunk of international and some EM in there. And again, everything else pretty normal. These are a better, even group of sectors. Let's look at what it does to do this. And the answer is, in the holdings, it invests in a bunch of other iShares ETFs. And again, you got a lot of them that people know. I mean, here's developed markets, emerging markets. Here's a bond ETF, MBB. I like these because a lot of these are the cheaper core series, so you're paying very little in fees. A lot of people would use this in a 401k plan, but they're putting it in the regular market, and that hasn't really worked. Target date ETFs haven't really worked in the ETF wrapper because advisors tend to like to be the deciders, but we'll see. It's BlackRock. We'll see if they can make this work, Katie, but it has been a challenge in the past.
Yeah, Eric, I'm actually in the target date 2025 ETF. I've got a little over a year left, so to each their own. But joining us now to talk about this ETF is Nick Nefouse. He is Head of Retirement Solutions over at BlackRock. Nick, it's great to have you with us. And this is a really interesting launch from BlackRock because, as I understand, of course, BlackRock had a different suite of target date ETFs that they shut down in 2014. What's different about 2014 and 2023?
Thank you very much for the time. I think the biggest difference that we've seen is the people who have access to the 401k plan and who don't have access to the 401k plan. What we've seen is this continued divergence between the Americans that do have that 401k plan. We find that much more of them are on track for a stable and steady retirement. So as those demographics have changed, we know people are getting older, they're asking more questions about retirement. So some of the numbers we think about, 57 million Americans lack access to a 401k plan. We know they're way more stressed out about 401k planning. That's on the demographic side. If you think about the actual product, though, in 2014, you've seen a major advancement in the usage of ETF, particularly in the individual market environment. So when we think about this for 401k users, most of them wouldn't use this type of a product. This is really for the individual investor. The last point that I'll make on this as well is what's changed. This is actually an active ETF. Now, we don't anticipate a lot of trading in the portfolio, but what this allows us to do is to implement a lot of our thinking on a more regular basis than what we were doing previously.
I've been talking a lot today about the Bloomberg story showing just a stampede out of active mutual fund shops, and it really has hit some of the biggest in the past few years. Are you concerned about that, or do you think because this is in an ETF wrapper, it's different?
Look, I think what we're focused on is the access for the individual. So the individual is trying to get exposure for retirements. And what this allows them to do is get a single ticker portfolio for that retirement planning. So again, this is technically an active ETF. We don't expect a lot of active in the traditional sense in this. What we expect is some of this updated research that would come in about every year, year and a half or so. So I think a product like this helps people, these individual investors, get closer to their retirement goals.
And I want to ask about this product. It's interesting what you're saying, access. So we know that half of Americans don't have any equity exposure at all. And the challenge is, how do you get them that? And, there's been ideas of the government, having them in index funds from birth or something like that. Are you going after those people? I'm assuming so, because this is a tougher sell in the advisor network because they like to decide the allocations. But how will you reach that 50% of Americans?
So this is the first step in reaching those Americans. And I think you said it right, that about half of Americans have access to 401k plans. They're well on their way with a lot of the auto features that are built into 401k plans. It's that other 50% that we're trying to help. The way I would see this really used is, I'm not sure advisors would use this as much as I would see individual people use this. Depending on the numbers that we look at, something like 47% of independent savers are relying on cash as their primary retirement savings tool. Now, a lot of them want access to financial advisors, either don't have it or can't access it. So I think something like this allows them to hopefully move out of cash and get the same types of returns we're seeing in 401k plans.
And what's the pitch to go into a target date ETF over a mutual fund or collective investment sort of trust, given that, as I understand it, when you look at the latter two, there's trillions of dollars in target date funds?
There are, and those are captive primarily in 401k plans. The ETF wrapper, I think, is going to help more with a lot of those taxable investors. We know a lot of those individual investors like to use the ETF. You've all reported it on this show even earlier today about just the real demand for an ETF as the primary vehicle that people are purchasing. So I think we want to meet our investors where they are, and where they are right now in this space is with ETFs. The taxes on ETFs are also an advantage in this space too. So we know that there will be trading over time, and the ETF wrapper allows us to have a little bit better of a taxable environment than we'd see in some of the other wrappers.
All right, Nick, thanks so much for joining us. Nick Nefouse there from BlackRock talking to us about target date ETFs. If you just can't get enough of ETFs, a reminder that you can listen to Eric and Joel Weber on Trillions. That's their bi-weekly podcast that covers the industry.
It's once every 2 weeks, right?
It comes out every 2 weeks.
Okay.
Every week we have this discussion. I wish they would just say their fortnightly podcast, but they refuse to change the copy. In any case, great podcast. That does it for the Bloomberg ETF IQ program. I'm Matt Miller, along with Katie Greifeld and Eric Balchunas. This is Bloomberg.